Imagine you have an extra $500 sitting in your bank account right now. You have two choices. Choice one, you take that money and you throw it at your mortgage or your student loans. It's safe. It's a guaranteed win. You feel a little lighter. Choice two, you ignore the debt, you take that same $500 and you put it into the stock market. You buy a piece of the 500 largest companies in the world. One of these choices could make you a millionaire. The other could leave you working until you're 75. But here's the problem. If you go on social media, you're going to hear two completely opposite rules. The debt-first camp will tell you that investing while you have debt is like trying to build a house on a sinking foundation. They'll say you're a fool to pay 20% interest while hoping for a 10% return. Then, there's the compounding camp. They'll show you a graph that looks like a rocket ship and tell you that every day you wait to invest is a day you're robbing your future self of millions. Who's right? The truth is, both of them are wrong. Because they're looking at a spreadsheet, not a human being. I'm Amy, a former investment banker turned financial educator, and I've seen people follow the perfect math and still end up broke because they ignored the one thing a spreadsheet can't track: human psychology. In this video, I'm giving you the definitive framework. We're going to run the numbers your bank doesn't want you to see. We're going to look at the hidden cost of waiting, and I'm going to show you the exact break-even point where the math flips. By the end of this video, you won't just have an answer, you'll have a roadmap. So you never have to second-guess your money moves again. Let's start with the debt-free obsession. Why is the advice to pay off every cent of debt before you touch the stock market so popular? It's because debt is the ultimate anchor. When you carry debt, you aren't just paying back what you borrowed. You are paying for the privilege of having that money early. And in today's economy, that privilege is more expensive than ever. In the US today, the average credit card interest rate is hovering around 24%. Let that sink in. If you have a $5,000 balance and you only pay the minimum, you aren't just in debt. You are in a financial emergency. At 24%, you're paying $1,200 a year just for the right to keep that debt. That's a vacation. That's a new laptop. Gone. Every single year. And it's not just the high-interest stuff. Let's talk about the good debt. Your mortgage. If you have a $300,000 mortgage at 6% and you pay it off over 30 years, do you know how much you actually pay back? It's not $300,000. It's roughly $647,000. You are paying the bank nearly $350,000 in interest. You basically bought the bank a house while you were trying to buy yours. This is why so many financial gurus are so successful. They focus on the math of the now. They see that 24% or that 12% personal loan, and they correctly identify it as a leak in your boat. And they're right. You can't win a race if your boat is taking on water. But here is where the debt-first advice starts to crumble. It assumes that your life is a linear path. It assumes that if you spend the next 7 years paying off your student loans, the stock market will just wait for you. Spoiler alert, it won't. While you are aggressively paying down a 4% student loan, something else is happening in the background. Or rather, something isn't happening. Compounding. Most people understand compounding in theory, but very few understand the cost of delay. Let's look at the stock market standard. Historically, the S&P 500, an index of the 500 biggest companies in the US, has returned about 8 to 10% annually over the long term, even after inflation. If you invest $100 today and it grows 8%, you have $108. The next year, you aren't just making 8% on your $100. You're making 8% on the $108. It feels small at first. It's like watching paint dry. But then, the curve starts to bend. Let's look at two people, early Emma and later Leo. Emma starts investing $200 a month at age 25. She does this for 10 years and then stops. She never puts another dollar in. By the time she's 65, thanks to that 8% return, her $24,000 investment has grown to roughly $450,000. Leo waits. He wants to be debt-free first. He spends his 20s paying off every loan. He starts investing $200 a month at age 35, 10 years later than Emma. No, he doesn't stop after 10 years. He keeps going for the next 30 years, until he's 65. Leo has contributed $72,000, 3 times more than Emma. But because he missed that first decade of compounding, his portfolio is worth significantly less than hers. This is the math of regret. When you prioritize paying off low-interest debt, you are trading a guaranteed 4% or 5% return, the interest you saved, for a potential 8 to 10% return, the market growth. But more importantly, you are trading time. You can always earn more money. You can never earn more time. Once a year of compounding is gone, it is gone forever. So the question isn't, should I pay off debt? The question is, what is the interest rate on my debt versus the expected return of the market? Okay, we're at the halfway mark. And if you're still watching, that tells me you're genuinely serious about getting smarter with your money. So I need to ask you a quick favor. Hit the subscribe button right now. I put out videos like this every single week, and subscribing is literally the best way to make sure you never miss one. It takes 1 second, costs you absolutely nothing, and it helps this channel grow so I can keep making this content for you. Seriously, just tap the button. I'll wait. Done? Amazing. Let's keep going. How do you actually run the numbers for your own life? We use a concept called financial arbitrage. Arbitrage is just a fancy word for taking advantage of a price difference between two markets. In this case, the two markets are your debt and your wealth. Here's the rule of thumb that I used back in my banking days. Step 1, identify the interest rate. Look at your statements, not the balance, the percentage. Step 2, compare it to the safe return. If your debt is 15% or higher, like credit cards, you pay that off with every spare cent you have. Why? Because there is no investment on earth, not stocks, not real estate, that will guarantee you a 15% return. By paying off that debt, you are effectively buying a 15% return with zero risk. That is the best deal you will ever get. Step 3, the gray zone, 6% to 10%. This is where it gets tricky. If you have a personal loan at 8%, the math is a wash. The market makes 8%, your debt costs 8%. In this zone, I almost always recommend paying off the debt. Why? Because the debt is a guaranteed cost, while the market is a variable gain. Why take the risk for a net zero result? Step 4, the wealth zone, below 5%. If you have a mortgage at 3% or a student loan at 4%, you are in the wealth zone. Mathematically, it is suboptimal to pay this off early. If you have a $10,000 debt at 4% and you put an extra $500 toward that debt, you save $400 in interest over the year. If you put that $500 into the market and it gains 8%, you made $800. You just made an extra $400 by not paying off your debt. This is how the wealthy stay wealthy. They use cheap money to buy expensive assets. Here's the part where the math nerds get it wrong. You are not a spreadsheet. You are a human being with a nervous system and a family. The math says, keep the 4% debt and invest in the market. But psychology says, the market just dropped 20%, and I still owe the bank $50,000. Let's look at a scenario that happens every single decade. A market correction. Imagine it's a year from now. You've been following the arbitrage strategy. You've got $20,000 in the stock market and $20,000 in low-interest debt. You're feeling smart. Then the market crashes. Your $20,000 portfolio is suddenly worth $14,000. You open your app and see red everywhere. At the same time, your debt hasn't moved. You still owe $20,000. The bank doesn't care that the S&P 500 is down. They want their check. This is where panic selling happens. People see their wealth evaporating, they feel the weight of their debt crushing them, and they sell their stocks at the bottom just to feel safe. If you do that, you didn't just lose money, you destroyed your future. This is why peace of mind is a legitimate financial metric. If carrying debt causes you physical stress, if you lose sleep over it, then the 4% spread you're making in the stock market isn't worth it. No amount of money is worth your mental health. However, there is a middle ground. It's called the hybrid approach. If you want to win at this game, you don't pick a camp, you build a system. Here is the exact step-by-step roadmap I recommend. Step 1, the Starter Emergency Fund. Before you pay an extra dollar to debt, and before you buy a single share of stock, you need a life buffer. Usually this is 1 month of basic expenses. Without this, you will just end up back in high-interest debt the moment life happens. Step 2, the employer match. If your job offers a retirement match, and you aren't taking it because you're paying off debt, you are setting money on fire. An employer match is often a 100% return on your money. No debt interest rate on earth is higher than 100%. Do the match first, always. Step 3, kill the toxic debt. List your debts from highest interest rate to lowest. Anything over 10%, kill it. Be ruthless. Put every spare cent toward that 24% credit card while paying minimums on everything else. Step 4. The core emergency fund. Once the toxic debt is gone, increase your buffer to 3 to 6 months of expenses. This fund is what gives you the diamond hands to stay invested when the market crashes later. Step 5. The 50-50th split. Once you're down to your low-interest debt, don't choose one. Split the difference. If you have an extra $1,000 a month, put $500 toward the debt and $500 into an index fund. Why? Because you get the psychological win of seeing your debt go down, and you get the mathematical win of letting your money start compounding immediately. The debt versus investing debate is usually framed as a war between two numbers. But the real war is between your current self and your future self. Your current self wants the relief of a zero balance. Your future self wants the freedom of $1 million portfolio. If you only listen to your current self, you might be debt-free at 40. But you'll be starting your investment journey from scratch, when you've already missed the most powerful years of growth. If you only listen to your future self, you might have a huge account, but you'll be living in a state of constant anxiety. The secret to wealth isn't a secret at all. It's consistency. It doesn't matter if you start with $50 a month or $5,000. What matters is that you stop treating debt repayment and investing as enemies. They are two tools in the same toolbox. Use the debt tool to fix your foundation, and use the investing tool to build your skyscraper. So, here's your homework. 1. Open your Notes app. 2. Write down every debt you have and its interest rate. 3. If it's over 10%, that is your target. 4. If it's under 5%, open that investment account today. Don't wait for the perfect market. The best time to start was 10 years ago. The second best time is today. If this video helped you clear the mental fog around your finances, hit that like button. And if you want to join a community of people taking control of their money through data, hit subscribe and turn on that notification bell. I've got a whole playlist on how to pick your first index fund right here, and a deep dive into the psychology of money right there. I'm Amy. Thank you for trusting me with your time. Now, go take action. I'll see you in the next video. If this gave you a new perspective, subscribe, and let's build smarter together.